Good evening, everyone. We'll stand and say the pledge. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Okay. And if you've got your cell phones, if you'd put them on mute, please. And we'll hand her over to our administrator and our auditor.
Thank you, Mr. Chair. There's a good group of people here. I didn't make enough copies for everyone. If you do want a paper copy at the end of the meeting, let me know. I can make one. The entire slide deck we're going to go through is available on the county website, so you can download it yourself. If you have questions about that and would prefer a paper copy, just let me know. I'll make that available at the end of the meeting. This meeting is about the proposed budget and levy for 2023. If you are here with questions about your valuation, our county assessor is here and our county assessment staff is here and they can talk to you about that, but we're not going to discuss valuations at this meeting. So if those are your questions, Jamie can help you, and she's got staff downstairs that can talk to you about your valuation.
There's actually two staff down in the county assessor's office. If you have questions about either classification or valuation, they will be here until 8 o'clock tonight. If you don't get your answers in that time frame, you're welcome to give our office a call tomorrow. Does anybody need me to show you where to go does anybody want to go down there for questions? I'll show you where that's at. And where's the phone number? If you have valuation or classification questions.
And what is the phone number we would call tomorrow?
732
3452.
3452.
You want 3452?
All right. You want me to start?
Yep, just as soon as it settles, you can start. Make sure to talk right into that one.
Yeah. Good evening. I am Kay Rave, the Hubbard County Auditor Treasurer. And again, tonight's Truth in Taxation meeting is to discuss the proposed budget and the proposed levy for 2023. We'll also discuss budget development, budget drivers, the levy history, tax rate history, levy impacts, you, the public, will have a chance to comment and ask questions. And we have a budget development process that we follow from year to year, and it is almost always very consistent. On June 10, managers notify the HR director of staffing changes, any new positions and/or reductions. Budget worksheets accessible to department heads as well. So they have everything they need from prior year's history and also current data from January 1 through June 30 of that year. On July 22nd, the budget data was entered into our budget software. August 2nd, we completed the budget detail and we distributed copies to the commissioners. August 9th and September 13, we had board work sessions and budget discussions, and those continued as was necessary until September 20, at which time we set the preliminary levy at $19,100,000. Again, in September through November, the board fine-tuned department budgets by discussing those changes and requests with department heads. And that brings us to tonight, our TNT presentation. On December 20, the board will set their final budget and the final levy for payable year 2023.
So the 2023 proposed budget and levy, as Kay just mentioned, requires a $19 million levy to support it. You can see that we've got it broken out in several different areas. The general fund is everything from the attorney's office to the veteran service office. Public safety is the sheriff's office and corrections, 911 communications, emergency planning. The highway department, I think, is relatively self-explanatory. Social services is as well. Solid waste has its own fund and budget line. Natural resource management is NRM. And then debt service, that is debt that we're paying on existing bonds.
Yep.
And then this year, we're showing, capturing $1.6 million in capital reserves for future capital and economic development purposes. And that's new this year, and we'll explain that in a little greater detail in a minute. You can see that the expenditures, the largest portion of our expenditures is from road and bridge. And that's because in 2023, we're going to have a significant number of projects to deliver. So sometimes we bank money and pool money, and then one year we'll have several major projects going on at the same time. Approximately equal parts go to support the general fund, the sheriff's office, and social services. Revenue from other sources, you can see that although the highway department has a major chunk of the expenditures in the budget, they also get a lot of revenue in to deliver those projects. So that revenue could come from from gas taxes, it could come from federal grants. Approximately 35% of our budget so you can see of 54 million, about 34% of that is covered by levy. The rest of it comes from other revenues. And those are usually from state or federal grants. We get a lot of revenue in for highway department and a lot of funding in social services department. And then the more important thing, you could look at this one as a dollar bill and say for every dollar you're paying in county taxes, 37 cents are going to the sheriff's office, 17 cents are going to road and bridge, 20% is going to the general fund, as I mentioned, is the attorney's office, the auditor's office, all the way through veteran services. 14 cents on the dollar goes to social services. 9% is going to capital reserves this year in the proposal, and 4% goes to debt service. A couple of significant drivers this year in the budget is that the jail is running at near full capacity, and it's requiring additional staff, and it's reducing our capacity for boarding revenue. Even 2 years ago, 3 years ago, we were boarding a lot of other people's prisoners, and we were expecting to have $300,000 worth of revenues coming in for that purpose. And we were able to run with a leaner staff because we didn't have as many people in the jail. The increase in the jail costs and the sheriff's cost related to that is represented by a $1.5 million increase this year. New positions that we are adding in the sheriff's office, we added 4 to run the jail. Early in March, the board had to approve those because we needed to meet staffing quotas for that. We've got 2 or 3 positions in social services, 1 additional staff in the attorney's office, and there's 1 position in solid waste that isn't on this list. A third budget driver is the implementation of a new class and comp schedule with market adjustments to stay competitive with regional counties. For the last 9 months, the Personnel Committee has been reviewing our current position relative to Beltrami County, Wadena County, Cass County. And as of October of this year, those counties were paying a significantly higher wage for starting and finishing in many key areas, sheriff's deputies being one. So we recently had a change into a new class and comp schedule and bumped us up to be competitive. We moved ourselves from 100% of the market to 110% of the market, and that has a cost associated with it as well. Other factors that are probably why so many of you are here tonight is that there were significant changes in the market value of residential property. That happened statewide, that happened countrywide, that happened as much here as anywhere. If you look at a map of residential property increases across the state of Minnesota, you'll see that 10 counties in the state of Minnesota had an average increase in residential properties between 27 and 37%. And you can draw a circle around us and Itasca and Cass and Beltrami and all the other Crow Wing, every place that has a lot of seasonal and lakeshore. And then you get up into the northeast corner of in Cook County and Lake County, and they also had the same increase. So our average increase in Hubbard County in residential properties was approximately 33% this year. And that's having a major impact on what tax statements look like. It's having a major impact on what your valuation statement look like. The other major factor is even amongst that change, bringing Enbridge Line 3, which is now 93 that it's pumping oil online, brought with it a significant opportunity. The investment, the Enbridge investment was somewhere between $250 and $300 million in Hubbard County. The old Enbridge Line 3 followed Highway 2 and ran through about 3-4 miles of Hubbard County, and we had very little tax impact as a result of that. The new route runs all the way down the western edge of the county and all the way across the southern border of the county. So instead of 3 or 4 miles, we have about 50 miles or more of pipeline in the county. And at the point in time when they were selling that project, they said, we're going to create jobs and then we're going to pay taxes, right? Well, they created jobs and now they're going to pay taxes. So the tax capacity increase from just that investment on just the Enbridge taxpayer was greater than 10%. That's why the opportunity to capture 10% on our levy, an increase on our levy to set aside for future capital needs and to provide for economic development needs in the county makes sense. Calculating their tax capacity and looking at the proposed levy, they will pay more than $1.6 million on that new investment. And then here briefly is, and if you have questions as we're going along, feel free to. Yep.
As far as the people, you know, the value thing.
Yep.
You do understand that a lot of these properties are selling for unrealistic amounts.
Yes.
So even though that being said, the rest of us still have to pay an increase because these people are paying double of what the properties were.
The only comment I can really make about that is the fact that everybody's residence went up at least 25%, and most of them went up 33 or more. That puts everybody at par relative to taxes.
And in this time in the country, everybody can't afford these things. Can't afford groceries or medical.
I completely understand that. However, the time to address valuation is in the spring when you got your valuation notice. We really can't do anything about that now, other than, as Jamie said, if your question is about your valuation and you want to make sure it's right, our staff is downstairs to answer those questions.
Never received an evaluation notice.
Yes, sir.
I understand the valuation from, I talked to the tax assessor in the spring when it came out, and he said, well, everybody's went up 100,000, but that probably won't take the tax up because everybody else went up. My taxes went up 33%. My concern, and the reason for your meeting here tonight, is the levy and the why, at this stage of society, what's going on, do we need to jump at that 1.6 million extra dollars? Yeah, everybody would like to have that in their slush fund. Everybody would. But there aren't any slush funds out there for these folks. And so that's my concern. If you wanted to start a slush fund for future development, you know, a percentage would be understandable. But when, you know, I'm on Fishhook River, I get an old house, you know, taxes go up $100 a month. I've got lots of friends and neighbors, the same situation, that can't afford that. I talked to a real estate agent today, and he said, November sales in Hubbard County this year versus last year, for the year are down 70%. So yes, there was a big flurry, but we're jumping on the bandwagon of this big flurry that has long since disappeared.
So the significant changes in the market value of residential property, if the board didn't raise the levy at all, you'd still see a tax increase because of the value of your property.
We would see a tax increase, but it probably, like I said, you've got 9% in your chart here of your slush fund, basically, future needs. And my suggestion is that we take a look at that and maybe tone that down.
That'll be a conversation for after. Let me finish the presentation, and then Chair Van Kempen will allow people to ask all those questions and have time. We really want people to come to the mic when they do that, so if you've got a specific question, let's bring people forward after we finish the presentation. I only have a few more minutes to go. So you can see here is a levy history broken out by those same funds we showed earlier. 2019 to 2020 was a modest increase. 2020 to 21 was a 0% increase. 22 was a modest increase. And again, you can see the larger increase in 23. One of the reasons why this is the time to do that is this is the only time to do it when you can only capture new tax capacity the year it happens. If we did this in the second year or phased it, everybody would see a bigger increase for that. So that's the reason for the proposal for doing it the year that it's earned, is that's the one time that new tax capacity pays that before you guys do. That's the one time that happens. It's not a slush fund. If you think of owning a business and you had a $10 million building, I would guess that you would set aside 5 or 10% a year for future capital needs. You should know that counties don't have any money set aside for future capital needs. This 1.6 million represents 1% against our $50 million worth of buildings that we're responsible for. So it's not a slush fund. It really is pre-planning at a time when we have somebody else who can pay a portion of that bill, so that when we have the next major improvement and repair, that we don't have to raise the taxes just to support that. We'll have some money to buy that cost down. Here's another statement of the county levy history. That breaks out public safety from, public safety, the sheriff's office, and corrections is technically recorded under the general fund. The counties and cities work on fund accounting. I like to split it out because it's a big chunk, and running a jail is really expensive, and we need to know that that's the case. One thing that's important to note is the county tax rate history. You can see we reached a high point of nearly 42% in 2018, and that has, or 42% in 2020, and that has coming down. And that's coming down as a result of a couple of things. A, the market increase and the tax capacity is going up, but B, when you look back at the levy histories, they were not keeping pace. When you have a 0% levy increase, the next year you're going to end up paying for that. And the board recognized that last year when we had a slightly larger tax increase. I don't have the current numbers for the surrounding counties on the budget and the levy and the tax rate. But Hubbard County's tax rate proposed on the numbers before you today would bring us to 32.3%, which would put us at the bottom of this chart. There's some other counties. Crow Wing has a lower county tax rate than Hubbard County does, but they have a significantly higher tax base and much more payers. Another thing that hasn't changed is, if you look on this, the tax rate comparison with the people geographically adjacent to us. Hubbard County has a very modest tax rate compared to the surrounding counties. And this only goes through 2021. You'll see that number would end up coming down somewhere into here this year, and some of theirs are going up. Here's an interesting point, and talks again about what the market rate has done. A $250,000 home in any one of these, Akeley Township, Crow Wing Township, Henrietta Township, their 2022 tax, everybody would have seen about a 19% decrease if the value didn't skyrocket like it did. Okay? Now, here's the challenge. That $250,000 home in '22 is not a $250,000 home in '23. It's probably a $330,000 home. That's the average, which means that change in tax is not a negative 19%. It's about a 6% increase. So those combination of things happen together. Yes, the market has slowed down. The number of transactions is decreasing. The fact that people are still paying above market price for homes has not changed very much. This levy impact, and I apologize for how small it is, but I've picked properties that are all in Henrietta Township so that we have a relatively fair comparison, so that we know that the local tax and the county tax and the school tax are all being allocated the same in these situations. And I've got houses in 2022 valued from $164,000 to $2.5 million. 2023 valuations, you can see the average increase on those properties was 33.7, which is statistically what the average is across the county. You can see that the county taxes on average across those properties increased by 18%. And the total taxes go up by 14%. If I take the homestead properties in here, I'll be right with you. If I take the homestead properties in here and I take out the $1.6 million, these 4 homestead properties, the average impact is $685 a month. Now, I know it's higher on the properties of higher value, but on the $250,000 and lower homes, the impact of that capturing economic development and capital money is very, very minimal. And honestly, I think that is all that I had relative to this year's budget and levy. So I turn it back to Chair Van Kempen.
All righty. I guess now would be the time for questions.
Now, I came to find out why the homestead exclusion went from 7,594 to 16,300. Homestead exclusion.
We'd have to look at your tax statement with you, we'd have to look at that with you individually. The homestead exclusion limits were not adjusted for 2023, were they, Jamie?
No, they were not. And if you have a question as to why your homestead exclusion decreased, we can go downstairs to, the county assessor's office if you like, and they can look that up for you.
Well, I came here to give my opinion.
Sure.
I don't know why we gotta go down there.
And if you have comments about the budget and levy for the board, this is the time to do that. If you have questions about your individual statements, they can help you with that.
I don't have an individual problem, it's just general. Another question I had is, I noticed here, capital reserves. Last year was 54,725, now it's 1,600,000. Why the increase in capital reserves? We're getting, percentage of increase real high, but we got that reserve. It's like the state of Minnesota's got a big reserve, do we need that?
As I addressed just a few minutes ago, this is the opportunity to capture that because of the Enbridge investment. This is the year we can capture that and have them pay for it. If we don't capture it this year, we don't have the ability to. And unlike the state of Minnesota, we know what those funds are going to be used for. They will be used for housing projects, they'll be used for economic development projects that will help the whole tax base. And in the future, they'll be used to buy down the cost of the major improvements on the $50 million of buildings the county owns. So it's a fair question. They're the ones that have to consider that policy, and this is the place to ask that question.
Yes, if you'd like to come up at the front and use the speaker.
This meeting is being live streamed and nobody can hear you if you don't use the microphone.
Well, that's great. Well, thank you. Chris Schneeman, we're on Lower Bottle. I am a township, I guess. And so the question, you had mentioned earlier that Enbridge is going to be worth $1.6 million in additional tax revenue. Is that a one-time deal, a annual deal? I mean, how frequently is that 1.6? Because that connects directly to this reserve that you're talking about. So, and just to editorialize a little bit, the reserve is normally an escrow that you build over time. And to say we're going to suddenly fulfill that thing in one tax episode on the residents here, I think is a little bit of a overreach. I mean, that should be something you'd budget out over years to create that reserve that you're looking for. So, but anyhow, is this an annual or a one-time windfall?
It would be an annual windfall. The specific amount would be relative to pipelines and transmission lines are assessed by the state. So we get the state assessed values in July every year and add it to our other values. I would anticipate that the board would be relatively careful to make sure that we manage to a consistent county tax rate going forward. So we would still capture as much of that as we could, but in subsequent years, it's not going to have, the only reason it's having an impact on anybody right now is because the market values went up at the same time. If market values had gone up 5% and 12% Enbridge capacity came in, nobody would have seen it on their taxes. If we don't collect it on the taxes, those people with $800,000, $1 million, $2 million homes are still going to see the shift because their increase in valuation, even at 33%, is significantly bigger than the increase in valuation on a $100,000 home.
There's a lot of moving pieces to this, and that piece is confusing, but it's really it's a separate levy than the rest of the levy. And if we don't do that, in the first year that tax capacity is available, that opportunity will not come along again without burdening the rest of the taxpayers. So that's the point of doing that. The only reason some homes are seeing the impact, as Administrator Cadwell said, is because we've got this perfect storm of valuations going up at 33% at the same time. So some of them see a little bit of impact in that, specifically as he spoke to the homes over 500,000, but anything below 250,000, very little impact at all. Most all of that is paid by Enbridge money alone. This county, in its history, has never had much of a capital improvement plan. We've kind of done it through the department heads in different ways, through each department, but we've never had a countywide capital improvement plan for planning for the future. And what happens then is we get lambasted as a board with a major capital expense that comes due, and we have to deal with that in one budget year. We have an opportunity here with the tax capacity that was created by Enbridge to better plan for the long term and start setting some of these things aside and plan for them so we don't have to bond as much in the future. I think it's a prudent thing to do. I think it's a wise thing to do. It's just unfortunate that the timing of it happened at the same time we have a hot real estate market and everybody's assessed values is going up, because it creates some confusion in that area. But the biggest driver to your property taxes is basically the evaluation increase. Those on the lakeshore properties are gonna see a higher burden because of that shift in value, and then public safety, as Administrator Cadwell pointed out. We have a full jail. It's costing us $1.4 million more to deal with the capacity in our jail than it did before. What do you do with that?
Well, I guess the two comments and then I'll give out the microphone, is one is the gentleman over here wisely stated that as the appraised values go up, then that tax rate should be going down. I know it went down a little bit, but not anywhere near what the increases in values were, which is what's stinging so many of us in the increased tax. And the second is that this multi-million-dollar annual, that sounds like it's an annual addition to the reserve you're talking about, not just a one-time deal.
Correct.
Depending on how the state
Okay.
ends up tax. I mean, they've been in error before and that number ends up getting adjusted, but that's
But it could
the
be
estimate.
it's a significant increase in revenues each year for the county.
Right, but realize,
Significant.
as I mentioned
Right.
just a few seconds ago, we haven't been doing any of that planning.
Well,
In a business, you have to plan for replacing equipment, replacing buildings. If you don't, you end up having to go borrow for all of that. And now all you're doing is you're shifting that by planning ahead of time instead of borrowing against future revenue. It's the same thing in the end. It's just a timing thing, and we have a tax capacity advantage here to take advantage of that now, that if we don't, it's gone forever.
Well, it's not gone forever because it's $1.6 million every year. So that's not,
If you don't
One and done,
capture it
so.
the first year, if we decide to do that next year and we decide to capture all the taxpayers will have to pay that burden. Right now, by doing it this year, Enbridge is paying it.
Thank you.
That's the rationale behind that piece of it.
Someone else like to come up and speak?
Hi, my name is Ron Johnson. I'm on Little Sand Lake. We don't actually have a structure there yet. We just have property. And we've only been there for 3 years. I apologize, I'm a computer programmer, so I've never set a budget. I don't know what it's like. So I guess just, and maybe this has been answered, but I'm gonna ask anyway. So the main reason for doing the big levy this year was Enbridge, right? But you know, you keep saying that we're not, I guess I don't understand that part. You say we're not paying that, but, you know, I look at my tax statement and I have a levy cost on there added to my valuation tax rate. So I guess that part, you know, and I know you said it's confusing me because it still feels like I'm paying for it, on top of the tax. And then, just again, going back to something you know, on the statistics, you said that the tax rate has actually gone down. So I would be paying less, but with the valuation, it's about a 6% increase, but my taxes are going up 23%. So again, you know, I can't do the math in my head and figure out if the rate that, and I'm not arguing the rate, you know, the valuation. I missed that boat. We weren't around. But, so with my valuation and the tax rate that you said has gone down, and you said it's about a 6% difference,
so
but
hope-
I'm seeing 23%, so I don't get that.
So hopefully, one thing that I can hopefully clear it up a little bit is Enbridge's tax bill is going up by more than $1.6 million in 2023 from Hubbard County. That's why we're saying they're paying that amount that we're setting aside. Their tax bill is gonna go up by more than that. I'm calculating 1.8, something like that off their tax capacity. So that's why we're saying that's happening. The reason that you're seeing a shift is that essentially, if you look on a sliding scale of home values, if you see a $100,000 home and it goes up 30%, it goes to 130,000. Their taxes are going down. You're paying them. I'm
Okay.
paying them. The people in the $300,000 house that went to 420, they're gonna pay a bigger portion. The people in this $800,000 house that went to 1.1, they're gonna pay a bigger portion. And the ones that are beyond that, because 30% or whatever the valuation increase was is bigger, so that decrease in the county tax rate from 39% to 32.3 is less than the increase in your value, which is why there's still some there. And that gap hits the higher valued homes more. When you get to a certain point, about $175,000, it ends up being a push. So no matter if we had the capital allocation in here or not, there was gonna be a shift from the lower valued homes to the higher valued homes because of that change.
Okay.
So that's why those numbers are bigger up there. a significant reason why a lot of lakeshore numbers are bigger is because a lot of lakeshore properties went up more than 33%, depending on the lake that they're on, the condition of the home. Especially this year, there was a secondary market adjustment for homes under 1,200 square feet. And homes under 1,100 square feet. So there were a lot of things that happened relative to the market to keep us in compliance with the state of Minnesota that pushed things up. And then those increasing prices meant that the tax shift, the tax capacity of the county prior to this increase was 73% residential, meaning that 73% of the levy was paid by residential parcels. Those 15,000 parcels, split that 75% of that. That portion didn't change. It would have changed because it went up, overall, our market went up by 27% because of the residential properties, but it didn't change because Enbridge bought it back down. If that makes any sense at all. The shift of the property tax to the residential properties was less than 1%. I think we went from 73.3 to 73.6 of our total tax capacity is still residential. So if we capture or don't capture, the shift to the higher valued homes was gonna happen the same way.
Okay. And I apologize, I'm gonna have
Those
to
are
ask
va-
another question.
Those are valid questions.
What's that?
Those are valid questions.
I'm trying to understand exactly what you're saying. I apologize. You're saying that the higher valued homes are having the bigger increase. We don't even have a house on our property. We have, and it's valued at 159,000 or something, yet it's a 23% increase. So, so we didn't, we don't have a high valued home. We don't even
Yep.
have a home on there. We got 2 sheds. So, that, to me, that doesn't make sense. We're not a high valued home and yet we went up 23%.
And your adjustments are because of where you are? And if you had a $150,000 house somewhere off water, it
Right.
would look completely different. But that $159,000 parcel on that body of water, all of the lakeshore adjustments went up. So, the value went up.
Okay, and then, so that brings me to another question, because after I got this, I started just poking around on your website where I can look at tax statements and things. And, on Little Sand, I think the lowest increase I saw was about 19%. And then one of my neighbors actually had a 55% increase in his home value, or in his tax cost. And I looked at just lakes right around us. I looked at Potato, Big Sand, and Boulder. And like you said, a lot of those went down, and most of them were in the single digits. There's one like 12%. But I guess that confused me too, is how, and I didn't, how Little Sand could be such big increases, and all the lakes around there were either negative or smaller increases. Any ideas on that? I guess, it looked like their values went up the same as ours, but,
That discussion was held in detail
Okay.
at the spring local board, county board of
Okay.
appeal and equalization.
And we don't have it
And-
in front of us, yeah.
Yep.
okay,
And if
okay.
you really, if you want more information on that, the assessor can dive into that with you.
Okay.
But basically, because the state requires all properties to be valued at 90 to 100, was it 105%?
Yep, 105.
Of market value. When they looked at all these different lake neighborhoods and stuff, based on what was sold and what the market did, they found that a lot of these smaller lakes, smaller homes, 1,100 square feet or less, were way below the minimum of 90% even. So they had to make those adjustments. And Little Sands being one of them, Spider was another one, quite a few of them like that. And they can go into more detail with that, but that's probably the core
Okay.
lakes are about that size that got hit the worst.
Okay, all right. And then, I don't have any more questions. I appreciate your time. But I do have a personal comment, and I'd just like to echo what a lot of people have said. It's just a really hard time to be doing this, with the way the economy is, the way the world is, I mean, it just really hits people hard, and I just wish it hadn't have happened, and wish you could do something different.
And I would add to that, you know, as taxpayers in the county too, I mean, we completely sympathize with that because it's affecting us too. And it's almost a perfect storm of a whole bunch of things going on at the same time. If you run a business anywhere in this country, you know how difficult it is to find employees. You know how quickly they're able to jump to another job and get a pay raise. So to stay competitive, we have to do our part here as a county board to stay competitive in wages, or we won't have people to do the work. You couple that with what the market's done and people coming in and paying inflated prices for homes. I mean, it's a double whammy, especially for the locals and especially for retired folks on fixed incomes.
Yep.
This isn't easy. It's really difficult. And we held the levy to 0% in 2020 due to COVID. Well, we're kind of paying for that now too, because, you know, our expenses are catching up to us, but we thought that was a prudent thing to do because people were hurting.
Yep.
But
Okay,
it's tough.
okay.
Totally get it.
All right, well, thank you.
Thank you. Anyone else like to speak? Yes.
Hi there. Sorry I was late. Maybe missed some things. Question, we bought a I have two areas I want to address. We bought a property on Little Sand. We closed on it, I think, October 6th. Lauren came out October 7th. And he goes, well, I'm in the area, I can do a assessment. I took him in it. The cabin hadn't been open for 5 years. It was filled with mold. The underneath was black mold, broken joists. Part of it was the kitchen. So that's gonna have to be replaced. New plumbing with new plumbing. The septic is 40 years old. It needs a new septic system. So it's a sort of a rebuild. So I said, Lauren, I'd like you to come out, assess it. And I think it was, at that time, the tax value was 308 or 318. And he sort of said, oh yeah, that's gonna have to go. And we get the property, and it went up $110,000 on a piece of property that you can't even live in. It was assessed
Yep.
as a livable piece of property. So
And
how does it go up?
And what you missed at the beginning is we can't address those valuation questions, but the county assessment staff is
Okay.
here to talk to you tonight, if you want to talk to
Yeah,
them about
okay,
that.
Okay. Second, as I looked around and on the GIS, and you guys are trying to raise revenue, I understand, everything's more expensive. I probably pulled up 7 to 8 businesses. Every one but one of them, their taxes went down 15 to 20%. Why are businesses going down and every personal is going up?
They're held to the same standard Commissioner De La Hunt just mentioned, that when we look at our sales study, we have to make sure that our assessed values within the county are within 90 to 105% of what the market is doing. So businesses were not selling during COVID.
If they were distressed.
Houses were. So what I will tell you is what we know about 2023 values is businesses are rebounding. Businesses are
right,
going to get.
'cause
So the reason for that is each class and each neighborhood has to fall within that 90 to 105% of the value set, or the state will come in. If we set it, we get it to 90, 95%, they're good. If we don't meet that criteria, they come in, set it to 105% and say, there, now you go, now you're ready. So anecdotally, I can just simply tell you that businesses were selling at a depressed rate for the last couple of years, while houses were selling at an expedited rate.
Okay, and it was like one example, the business, Walmart, where they do pay a lot of property tax, but theirs did go down like 45 grand.
Yep.
I'm like, how does that work?
It's because the commercial property value
As a whole.
increased as a whole at a very, very minute ratio compared to the home sales.
Okay, I just thought that was very curious that businesses, is that why possibly we're getting taxed more because the businesses are paying less taxes?
No, as I mentioned,
Well, you sort of did, well.
well, as I
and you said
mentioned a
no.
minute,
Burden shifts a little.
That's what I'm
well,
saying.
it does and it doesn't, because of our tax capacity, the shift to residential was less than 1%. So residential parcels are paying 73 to 74% of the levy. They were paying 73 to 74% of the levy before. So that, the decrease in commercial is not, it's not a decrease, it's just they didn't keep pace. And some of them did go down.
Okay, right, so, I guess the other question is, your budget is going up 19% approximately?
That's the proposed preliminary,
Proposed,
yes.
right. So when I actually, last spring, whenever I called into the assessor's office and they told me how everybody's property's probably going up, but it's sort of your piece of the pie, your little percentage. That's how it works. And he said, typically, the county budget goes up 4 to 5% a year. Because it's going up 19%, or proposed 19%, is that the reason also why our, the thing, it's going up? Because he said, oh, you're gonna go up, but not as much as you think.
Of that 19%, 10 of it would be for Enbridge. And then of the 9% that's left over, approximately 6%, if I'm correct, goes for the sheriff's department because of the increased staff we need for the jail, as we said, is full right now.
Right.
And then, of course, and like David had mentioned earlier too, it's kind of a perfect storm because we just had union negotiations. We have 7 unions that represent the staff here at the county. And of course, with record inflation, I think we still did a good job at trying to keep the wages down. I believe the first year was a 4% increase.
3,
3%?
only 3.
So it's, we're doing that, but that's kind of normal increase for union wages. But yet, like you say, you tack everything together, increase fuel prices, increase equipment costs, on and on and on. And I understand that not everybody gets a raise in Hubbard County or the state.
Right.
And,
So, and you guys talked about the perfect storm and everything going up, and we're getting hit with a property tax increase. And at this same perfect storm, interest rates are going up. And as our value's going up, on paper, our real value is already starting to go down. So you're sort of, a little behind the increase because our values are gonna go down. When is the next time you're gonna assess?
well, Jamie, they do a jail
Rates are adjusted annually.
sales study every year.
Okay,
Yeah, rates are
But they
adjusted.
don't-
You'll get your new valuation notice in the spring.
right, okay.
And they're usually about a year or 2 behind.
The sales study is
current
12 months
conditions.
behind.
So the values that you have right now.
Right, so I just think that's sort of like the double stinger. Yeah, it's up, but really, no, it's not because it's already tailing off. So it's the backside of the storm, sort of.
The real stinger is if it went up 5%, everybody went up 5%, and we were all in a $100,000 to a $200,000 house, everybody's change would be really moderate. The real stinger here is we got people living in $100,000 houses and $3 million homes, right? And more, and 33% on $1 million is more than 33% on 100,000.
So
It is.
I just wanted to bring that up. I
Yep.
thought it would be interesting. I don't know if people knew that if you looked up businesses, they're going down, to share that with people. And about my assessment, I did try to reach him to see if he could explain how, because when we met, he was sort of like, oh yeah, I totally understand. We can get this in before the fall paperwork.
Yep.
And he's never responded. So I
the-
did try.
The person to call then is our county assessor.
Okay.
We use local assessors in the townships and in the cities. But they all report back through and to the county assessor.
Okay.
And that's where the final value is, and that, when you get your valuation notice in the spring, it's gonna come from our office, it's gonna come from Jamie's office.
Okay. I just wanted to know,
And-
I did
and-
try to reach him to, he could explain
Yep.
why
But
this
then
happened.
the balance of that process is you go to your local Board of Appeal and Equalization and say, hey, there's some characteristic about my home or my property that's not represented in this value.
And that's what
And they take action, or they don't take action. Then it goes to the County Board of Appeal, and they take action, or they don't take action. But just having a conversation with a person doesn't always translate into something getting done, unfortunately. And of the 177 appeals that we had this year, none of them resulted in action, because the majority of the appeals said the value went up too fast, went up too high too fast, and everybody's did.
Right.
So unless somebody brought forward characteristics of their property, and then almost every one of those adjustments were made, right? So that, the county assessor wants to make sure they have the appropriate and accurate information. If you believe they don't, that's the conversation to have, and directly with Jamie and her staff will get you the results that you're needing.
Okay, thank you.
And I'd like to add in here before we forget to pass it along, but I believe Minnesota has kind of a circuit breaker type of thing through your taxes, specifically for cases where your taxes increase more rapidly than typical. Do you know what that form is?
Yeah, actually, it's on the agenda for Tuesday. I don't have it in front of me.
Yeah.
But there
make
is a-
sure, make
there is a-
sure you
there's-
talk to your account
have your
about
name?
it.
I think that's,
David?
Dave, I think that's income-based.
No,
Oh,
there's
it's-
two
We
components to
visited on the
that.
phone today, Woods.
One is income-based, and one
You're
is
right. You're
strictly
right.
based on the size of your increase.
I gave her Jamie's phone number.
Oh, okay. Thank you.
So
Thank
we
you.
will, I have that on the agenda for Tuesday, I just don't have it in front of me.
Yeah, but just when you do your taxes this year, ask that question of your tax preparer, because you possibly could get a refund if your taxes went up too high from the state. It's worth asking the question.
Okay, would somebody else like to come up and speak?
My name is Scott Rising. I live here in town. Quick question about the, two things, actually. The tax levy itself. I don't quite understand where that comes from, and that's okay. I'll get that from downstairs. But the basic levy, is that the same across all properties, or all properties are different?
Well, as far as their evaluations going up or down,
No, had nothing to do with the evaluation. Whether I live in $100,000 worth of property or 200,000, is that levy level across all
No.
of the value?
I don't
So
remember how
what,
many-
there's one piece that a lot of people miss, and a lot of people hit this year. Your residential property is, the tax capacity of a residential property is calculated as 1% of the value up to $500,000. And then 1.5% of the value above $500,000. So if you never had a $500,000 home and now you do, your tax capacity as a percentage of the value of your home is higher than it used to be. Does that answer your question at all?
No, because
Okay.
you're talking about the maximum levy. True? Or is it always 1% plus?
The tax capacity of a home in Minnesota is 1%.
That's the
Seasonal and
max.
Unless, for everything up to 500,000,
Okay.
and then for everything over 500, it's 1.5%.
So you tax at 1%.
The state tax is at 1%. The county tax rate is 32.3%, so we're only taxing 32.3 cents on the dollar, 33.2. Okay.
Okay.
So,
I'll have to do some homework to
yeah,
understand that. That's all right.
I'm not quite understanding the question.
Okay, here's the second one then. You're proposing a $1.6 million capital reserve. Is that a savings account for capital projects, large capital projects?
At the last board meeting, they had a conversation about using a third of that for economic development, a third of that for 2023 capital needs, and a third of that going towards future capital needs.
Okay. So I can expect in the future that this 1.6 million will stay level, or it'll follow some kind of inflation, or what's the top of that 1.6 million? Are we gonna do that every year?
And I think I answered this question earlier, that the valuation on those tax state assessed utilities comes out in July every year, and that will have to be taken into account and reconciled with the tax capacity of the county on all the other parcels that we're responsible for assessing. And then I would imagine that the board's goal, as we show the tax rate going down, would be to keep that there or even slightly lower. So yes, that number would be managed relative to the overall capacity of the county.
But 1.6 million is neither a cap nor a floor. Total dollars.
It's, for the foreseeable future, we're planning on that being a stable number for the next 3 to 5 years.
So if $1 million of that is spent this year on the three things that you list here, and you don't have a third of it left, next year we will fill that back to 1.6. That's the plan?
The plan is to actually collect 1.6 annually for the next 5 years and then evaluate. But we'll have to evaluate annually when we get the data from the state. The next proposed remodel on the jail is $7 to $10 million.
No, I
If
get
we
it.
don't save towards it, then we just have to borrow $10 million at the time.
I get it. I get it. Thank you.
Anybody else like to speak?
Anecdotally, Stearns County is looking at a $250 million jail. And I told them that's not $250 million, that's $250 million, and it'll be $400 million before you're done. Jails are very expensive.
When's the perfect storm over? Keep talking, this is the perfect storm this year, but next year is still 1.6 million. When are we done with the perfect storm? What do we look forward to?
If we knew the answer to that question,
Well, the
I don't
biggest-
think we'd be here right now.
The biggest piece of that is relative to, honestly, right now, the interest rates are our friends relative to moderating the prices that homes are selling for. I moved here a year and a half ago. I could not buy a home on a lake because people were in bidding wars, right? That was the market that we had for 2 years. That market is slowing down. So that portion of the storm relative to the skyrocketing increase in property values, I think is slowing down. And honestly, the interest rates are the only thing helping that right now because people are still buying. There's just not as many people buying at that rate.
Mr. Chair, I'd like to comment.
Sure.
I know it's really frustrating on the local level. However, part of the perfect storm is policy that is out of all of our hands, but it's policy made by people that we elect into office. So I would just like to remind people that no matter where you stand politically, we were energy independent, and now we have skyrocketing energy costs. If you're frustrated, contact the people in Washington who are making the policy decisions. And also go and vote who you think is the best possible candidate when you have the opportunity. Because some of this stuff
Oil
we,
is a commodity sold on the world market, whatever the world will bear, like grain.
and
this
so
is
some of this
here
is
locally,
over our,
yet globally. And the mall must understand that.
but it is very frustrating, and it's also scary. You know, people are having to decide how they're gonna pay to heat their homes or feed their families.
Just like they said here, there's plenty of people coming up in the city to purchase a second home on these lakes. They are paying the prices. So until people stop coming up here, prices are gonna go up. Every one of us know that.
Yeah, I agree. I don't think it's the local people that are overpaying for their homes.
No, you
Everybody
didn't.
wants to come here. It's a wonderful place. I moved here.
Same here, but that was like
I thought
40
it
years
was
ago.
cheap,
Yep.
so.
And I think part of the driver was with the pandemic, and a lot of people could do their jobs over the computer. They realized that here in Hubbard County, we have great, 1 gigabyte internet speeds. So why not buy a place up in God's country where I can do my job?
That's right, if you're gonna weather out the perfect storm, it's perfect
Yeah.
here.
So then they started overpaying. It's crazy. Would anyone else like to speak?
I just want to add, I was saying, values are already going down a little bit. Budgets are going up, higher expenses. If values go down, let's say 8%, taxes are, your property taxes should go down because your value went down. Where are you gonna make up the difference for your budget if next year goes down?
Values aren't gonna go down next year. The housing study is from October 1st to October 1st. The values
are already going.
The values are not gonna go down for '23. They will moderate. They will not be a 33% increase. I don't know, I haven't seen the numbers.
And
But from everything I've heard, they've not gone down.
And values don't determine how much money the county collects. The county levy does. The value just determines what portion you pay.
Yeah, okay.
And also, as the values go down, you're not gonna see that on your evaluation next year on your tax statement because of the
delay.
dates that the sales study go. Government, as you know, moves very slow, and it's retroactive, or it's reactive, excuse me. And so, it'll be probably a couple years before you actually see that on your property valuations.
Sorry, could you explain what you just said about you don't pay taxes on the value you pay on the levy? How did you?
The county generates its revenue off the levy,
Okay,
okay? And then that levy is spread out amongst all the taxpayers based on your valuation. Your valuation is just used to help determine what's your portion of that tax burden. So just because your value of your properties go down, that doesn't mean the county gets any less money. If the county sets its levy, it's going to get those dollars. It's just how it's collected is determined by your property value.
Now, if everybody's value went down, but somebody else's value went up, well, then they would be paying a larger share of the tax levy.
And Minnesota also has the most complex property tax.
They do, but it's boiled down to be very, very simple. There's very few differentiations. Residential.
You cannot figure it out
No.
without a computer.
No, seasonal used to pay a higher rate than homestead, and it doesn't anymore. The only thing that does is when you hit that 500,000. The two things that the legislature has not adjusted and should adjust is they should adjust that point where that 500 should be higher. And the homestead exclusion number should be bumped up a little bit because neither of them have kept pace with the change in market. Those are the two easiest slam dunk things to do relative to property tax relief for lower valued homes.
sorry, I'm gonna ask another question then. So our plan is to, like I said, we don't have a home yet. Our plan is to build a home next year. So, people have been talking about homestead. So is that something, since we're gonna move here and live here permanently, is that something that we can do, is apply for the homestead, and would that help with taxes, or is that, because
It really doesn't.
it doesn't, okay,
20 years ago it did.
okay,
But yes, if it's your primary residence, you want to list it as homestead.
okay.
The homestead, the market value exclusion is separate from homestead versus seasonal property. But yes, when you live here, you will want to file for that.
And I did, yeah, and that's, and I asked the question because when I was doing my research, I noticed that some people who have a homestead exemption, last year their home value was here, and their homestead exemption was here. This year, their home value is here, and their homestead exemption.
So the homestead exclusion caps out at like $420,000. So you get the full exclusion up to $120,000 of value, I think, and then the exclusion falls away as you get closer to the top, and when you get to the top of the scale, it's zero. And then it doesn't apply anymore. And I'm using those numbers anecdotally, there's something like that in that area. But that exclusion disappears over time in that gap. There's a point to which you get the whole thing, and then it goes away completely. And I talked to a gentleman last week who said, well, my house went from $300,000 to $400,000, and my tax exemption went away. And I said, your $10,000 tax exemption was not a tax exemption. It was a $10,000 deduction from the tax capacity of your home, and then your taxes were calculated off of that. So your taxes were calculated on $390 instead of $400,000. I said the net was about $100, and he was happy to learn that and disappointed that at the same time. Yeah, those programs need to be adjusted to the current market, and they don't have as much effect as they used to. And the reason that I say that homestead is not the same discount as it used to be is 20 years ago when they put in place the state general sales tax. So seasonal properties pay into the state general sales tax, and they don't pay against local school bonds, right? And the homestead pay against the local school bond and don't pay into the state general sales tax. They've never adjusted the amount of money they're collecting from the state general sales tax. So about 3-4 years ago, seasonal properties are actually paying a net lower tax rate than homestead properties. Now, that varies by local taxing district, but the benefit of having a homesteaded property has gone away because the state general sales tax has not kept pace with the market either.
Question. We talked about the 19% increase for the budget. Typically, you probably have a 3 to 5 year plan. What are you seeing in the next 3 to 5 years for budget increases?
So they asked me that, I wanted to see which one, they asked me that at the last meeting. And I said, new tax capacity growth plus 3 to 4% will balance the budget over the next 3 years. And our new tax capacity growth, short of Enbridge, is typically about 2%, Jamie?
That's a key question.
Between the two of you, I'll just answer, it's about 2%. So about 3 to 4% on top of the new tax capacity captured.
So we're not looking at another 15%, 18%?
No, I think each of them individually said, we're not doing this again, are we? And I said, no, we don't need to do it again.
Okay.
Because we can collect it off of that,
Good to hear that.
we can collect it off of that value against Enbridge without it affecting everybody else.
Is there depreciation on utilities?
Yes, but there will not be any appreciable depreciation in the first 5 years of the life of that plant. So that's why projecting out the first few years of this, my projections show the same number for the first 5 years. And then there will be depreciation, and it'll be adjusted accordingly. There's actually gonna be a bump next year because this year we only got credit for the value of the structure. Next year we'll get credit for the value of the oil through it as well. So there will be another opportunity with that. But
I have one other question. Do you guys have like a savings plan of some sort if lakes get in trouble, like there all of a sudden are harmful algae blooms or something like that, and you have to work to protect your assets?
we have related agencies that work on those. SWCD and other agencies are working on that. They're working statewide on those things. The county does not have any money towards those things, but the state does, and they address outbreaks.
Eric has a small amount in
Yeah.
his budget that he's put aside, 200 and some thousand, I think is what's in there.
Environmental services, yeah.
Yeah, but it's
Very
not-
small.
The plan here isn't for the county to step in and because we can't afford to. I see what you're asking, but it's hundreds of thousands of dollars.
Okay, would anyone else like to speak or have questions? I guess I'd just like to say that, yes, this is a tough year for us. We're still trying to bring the budget down. None of us wanted to see this year and definitely do not want to make a habit of this kind of an increase. Like David said, 2020, we had a 0 increase. I believe it was 2% after that. You know, that's the kind of levy increases that I myself would like to see, would be that 2, 3, maybe a 4% type of deal. But this 19%, and even if you take away the 10%, and that makes it 9, none of us are happy about that.
But one thing to remember is we're trying to, there were parts of social services that were using the reserve funds, and instead we put that in the levy. The general fund was taking money out of the reserves, and so instead of just allowing that to continue, we're trying to give a realistic picture. So part of the 9% is putting that also into the levy.
Is there any other questions? Yes.
This is a detailed question, but you were talking about the sheriff's budget going up and the jail is full. I'm just kind of curious, is the county changing that the jail is full? I mean, I know a year and a half ago or 2 years ago, there's a lot of activity going on at the jail, but I'm just wondering why now it's full and we aren't being able to get revenue instead.
So I would answer that roughly by saying that we have more effective DUI enforcement than we did previously. And we also just recently got a grant for an additional DUI enforcement officer. So the state is helping us to crack down on those things, and the unintended and unfortunate consequence of that is the jail's full.
Thank you.
And I would add to that, that coupled with just the generalization that crime across the whole state and across the whole country is up for a variety of different reasons that I won't go into. I think everybody can make their own opinion on that, but there's just a general increase, and you have to make a choice whether you're going to hold people accountable or you're not.
Got it.
Right. Yeah, if you look at the custody list, 85% of the inmates are there for drugs or alcohol related.
I have a question. So at one time I was thinking that we were housing individuals that were incarcerated in our county from other counties, and we were sort of like renting our space. Are we still doing that?
We were doing that, and we are not able to do that. So we had up to $300,000 a year in revenue for boarding of other people's prisoners, and now we don't. So I think for next year, we're only budgeting $50,000 on that. We do still have some. And what they end up doing is they end up swapping prisoners, because when you've got a jail that has a capacity of 95, it really is full at 82. You can only get to 82 if you have the right mix of male and female, and violent and nonviolent, and all of those. Everybody needs to be segregated in those ways, which is very likely the next improvement at the jail is to provide more flexibility in our ability to do that, not to make more cells. So yes, we're short $250,000 in revenue, and we're long $750,000 in staff, and that's a big number.
I know you're talking about the improvements to the jail. Did you mention a time frame, or is that in the
No.
plan? Okay, so not
No,
in the plan yet.
it's on a future capital plan.
Okay.
Well, at this point, all we got are bubble drawings that show what could happen, but it's not been prioritized, it's not been identified.
There's another question.
So if you have any house, just pick a house, any number, and if you live on a lake or you live in town, are the tax, is it all the same, or living on a lake goes way up more, or living in town, or is it even keel?
So when you have a house on a piece of land, your home has value, the land has value. If you live on a lake, the front footage of the lake has value. So all of those things are added. If you don't live on a lake, you don't pay the additional value of the front footage, right? So, and then there's market adjustments relative to that. But each of the local taxing districts, like the different townships, each of the different cities, they each have their own levies. So when you look at your tax statement, you're gonna see a county tax, you're gonna see a school tax, you're gonna see a local tax, which is either gonna be a township if you live outside of a city or from the city. The city taxes are usually much higher because they have typically water and sewer infrastructure and other things to pay for. So no, they're not equal. And yeah, and then there's neighborhood adjustments that are put on primarily on the lakeshore properties because those are sought after. They're more valued by people who are buying homes. The same rules are used to value all of the properties, but they don't come up with the same value because of some of those reasons.
Okay. Sorry, got another question. This might be, just with looking at the statement. So there's two levies, the voter approved levies and other levies. Are they all lumped into this $19 million?
So we're only having a conversation about the county line on your tax statement.
Okay, so that's something else?
That the voter approved and the other levies are the school levies.
Gotcha, okay.
Yep.
Thank you.
And an HRDC levy, which they set out of the office in
Yep.
Bemidji. We
Yep.
don't set that here.
Anyone else? I guess if that's it, we'll adjourn for the evening. I want to thank everybody for coming. You had a lot of good questions for us. Thank you.
And if you wanted a hard copy, I'll get it for you.